First, you have to add the amount which is available in the capital structure. So 25 lakh goes to in favor of equity share capital. The new weighted capital raises additional capital 15 lakh by 10% debenture. The additional debt would result in increase in expected dividend of rupees 5. However, growth rate remains the same and market price becomes 8. Hello my dear students, I am Dr. B.S. Subramanya, called by name Dr. B.S.S., Professor in Commerce and Management, Vidhyaashram First Aid College, a Temple of Excellence, MYSURU. In this session, I am going to have Financial Management 4th semester, Unit 3, Session 3 in favor of BBA. Cost of capital. In the cost of capital, today I am going to explain what is weighted average cost of capital. So far we did the capital structure. Now we are entering into weighted average cost of capital. They will give like this. This is their capital structure. They have got an equity share capital of rupees 25 lakh, 8% preference share of rupees 7 lakh 50,000, 6% debenture. This is their existing capital structure. This is 12 lakh 50 plus 50, 13 lakh 20 plus 25 means 45 lakh. 45 lakh they are having. So in that 45 lakh, they have got 25 lakh in equity, 7 lakh 50,000 in preference share capital, 12 lakh 50,000 in 6% debenture. The market price of equity share is rupees 10. The company is expected to pay a dividend of rupees 4 per share, which will grow at 8% forever. If the tax rate is 35%, compute the following weighted average based on existing capital structure. You got your existing capital structure is there. First, you have to give the weights for them. Then you have to find, I will give the format. Source, amount, weights, specific cost, weighted average cost of capital. Source. First one, equity share capital, equity share capital, what is your equity share? 25 lakh. Existing. Then 8% preference share capital, 8% preference share capital, 7 lakh 50,000. Then 6% debenture, it is 12 lakh 50,000. What's the procedure? No? First, you have to add the amount which is available in the capital structure. So 25 lakh goes to in favor of equity share capital. 7 lakh 50,000 goes in favor of 8%. What's the 8%? Rate of dividend. 6% debenture means rate of interest. So 12 lakh 50,000. If you add all the figures, 25 lakh, so 45 lakh is the total source. Then how to find out the weights? 25 lakh divided by 45 lakh, 7 lakh 50 divided by 45 lakh, 12 lakh 50 divided by 5. How much it occupies, how much equity share occupies, how much preference share occupies, how much debenture occupies. What that is? Here in the 45 lakh, how much equity share capital occupies, how much preference share capital occupies, how much debenture will occupy. That we have to calculate. We'll move on. 25, 20, 30 divided by 45, 20, 30 is equal to 0.55. So it occupies about 55% of capital. Equity share capital will occupy 55% of their capital structure. Regarding the preference share, 75030 divided by 45, 2030, 0.166, 0.166. You can say 17. 12 lakh 50,000, 12 lakh 50 divided by 45, 2020, 0.277. You can say 28. 28 we can take. Now, specific cost you have to calculate. Working note. For equity, specific cost for equity. Formula: dividend divided by market price of shares. What formula? Dividend divided by market price of a share into 100 plus growth rate. This is the formula. What is the formula? Dividend divided by market price share in 100 into growth rate. We'll apply now. Come back here. The market price of share is rupees 10. The company is expected to pay a dividend of rupees 4. Come back here. Dividend is 4 divided by, what's your market price? The market price of share is rupees 10 into 100 plus, what's your growth rate? The company expect to pay different, while the growth rate 8%. So 4 divided by 10 into 100 is equal to 40 plus 8, 48%. This goes to equity. Preference share capital, whatever the percentage is given. What is the percentage is given? 8%. Preference share capital is equal to 8%. Debenture I into 1 minus T. I means interest rate into 1 minus T. What's your interest rate? 6 into 1 minus. What's your tax rate? 35%. 0.35. This is 6 into 1 minus 3.35. 1 minus 0.35. 0.65. 0.65 into 6. 3.9%. Now, apply now. Come back here. Specific cost of equity 48. Regarding this preference share capital 8. Regarding the debenture 3.9. multiply 0.55 into 48, 26.4, 0.17 into 8, 1.36, 0.28 into 3.9, 0.28 into 3.9, 1.092. Add, this is 2, 15, so 28.85% existing. New one, this goes to existing. Now, formula, dividend divided by market price is 100 into growth rate. New capital structure. Source, amount, weights, specific cost, WACC. Source, equity share capital, equity share capital, amount 25 lakh. Then 8% preference share capital, 8% preference share capital, 7,50,000. Then 6% debenture, 12,50,000. This is an old one. So what's the old one we have got? Equity share capital occupies 25 lakh, preference share 7,50,000, debenture 12,50,000. No, new one. The new weighted capital raises additional capital 15 lakh by 10% debenture. 10% debenture, 15 lakh additional. Now, add the figure. 45 lakh, 50, 60 lakh, 0, 60 lakh. Total cap. So, out, previously it was only 45 lakh, an additional debt of 15 lakh, totally 60 lakh. Now we have to find out the weight. 25 lakh, 25 divided by 60, 20, 30, 0.42. Then 75030 divided by 60, 0.125. You can say 13. 12 lakh 50 divided by 60, 0.208. Then 21. Then 15 divided by 60 lakh 60, 0.24. So this is your weights. Totally equal to 1, no? 2 plus 3, 5, 6, 10. 5, 8, 5, 6, 8, 10. It is equal to 1. Now, specific cost. for equity. Same formula. Dividend divided by market price into 100 plus growth rate. Come back here. The additional debt would result in increase in expected dividend of rupees 5. However, growth rate remains the same and market price becomes 8. Dividend become 5. Market price of the share is 8 into 100 plus growth rate remains the same. What's the growth rate you have got? Last one. What's the old growth rate? Dividend 48, debenture, weighted average cost of capital 48, 8. This is 8%. 5 divided by 8 into 100, 500 divided by 8, 62.5 plus 8, 70.5. 70.5. This goes to here. Preference share capital same. New debenture, new debt, I into 1 minus T. What's your I? 10 into 1 minus 0.35. That is 10 into 0.65. 10 into 0.65. 6.5. New debt. Old debt is equal to, old debt is equal to 3.9. This is old percentage. We'll apply now specific cost. Specific cost for this is 70.5 into preference share capital same 8, 6% debenture old 3.9, new is 6.5. Multiply 70.5 into 0.42, 29.61. Then 0.13 into 8, 9.04. 0.21 into 3.9, 0.81982. Then 0.24 into 6.5, 1.56. Add 29.61 plus 9.04 plus 0.82 plus 1.56, 41.03 percentage. 41.03. This formula you have to require dividend market price of the share into 100 into growth rate remains the same. Dividend change, market price change, growth rate remains the same. We already calculated this 8. This you have calculated. This is a new one, 10%. Hope you understand. First, we have to give the weights for the capital structure. Then you have to find out the specific cost for equity. For equity, what is the formula? Dividend divided by market price of the share into 100 plus growth rate. Regarding the preference, whatever the rate is given, you have to take. Regarding the debenture, T into I into 1 minus T. T is called tax rate, I is equal to rate of interest. Then you have to multiply, weights multiply, you'll get the weighted average cost of capital. Hope you understand. We'll go to another problem in the next session. Till then, goodbye. Meet in the next session.